Good morning.
Yes, yes, Mark. Welcome back to F.A.C.E. You're on camera. What the heck? This is what I look like on a Friday. All right, buddy. So, first of all, reaction to the better than expected NFP.
Yeah, what can you really say, right? I mean, I think, of course, what it shows is the resilience still of the labor market. It is slowing. And I think that to me, there would be so, of course, we're trading off of the strength of the number. And what this means is that the Federal Reserve is still going to be raising rates 75 basis points later this month. Underneath the
Okay.
surface, a couple of things that stand out to me. One is that for the third month in a row, average hourly earnings fell. That's a year over year pace slowing. This is a source
Interesting.
of inflation. Secondly, the average work week fell. I know a tenth of an hour doesn't sound like a lot, but when you have over 100 million workers, a tenth of an hour turns out to mean something in output terms. And the third
Okay.
thing I would say is that broadly underneath the surface again is the pace of job growth is slowing. And when
Yes.
Powell talks about the labor market, he says that the Federal Reserve has one number in mind when they think about inflation. And then he says, but there's a lot of different indicators for the employment data. And I'd say the weekly jobless claims rising, the continuing claims just slowly coming off of the lows, and now a slowdown in the labor market. This is what the Federal Reserve wants. It's not going to inhibit them at all. 75 basis points later this month, 50 in September.
Well, since you're talking about labor, Mark, let me ask you this: since a lot of people did go to the markets during COVID, and a lot of people were feeling the wealth effect during COVID with a huge parabolic great move in stocks, parabolic in real estate, and that's changed. Could the great resignation turn into, hey, I have to go out and make some money in the days ahead?
Well, I think that's partly true, but this is part of the weakness. I think that someone had previously mentioned as the data first came out was that the participation rate.
Right.
So, in some ways, the participation rate never got back to where it was in the before the great financial crisis.
Okay.
Canada, for example, had basically gone back to where they were before the pandemic. So the U.S., we do have this low participation rate. I think it's a big demographic, sociological issue going on. And it's a lot of guys like us, Dale, unfortunately, guys who are, say, older than 50, retiring early,
Oh, I just
not wanting to
started.
have
I'm at 51. Yeah.
51 again. And but I think this is the problem. I mean, is that we have a very low historically and relative to other high wage economies, a low participation rate. And this is part of the thing that's holding the economy back.
Okay. And that's also part of the thing that's pushing the Fed forward.
Yeah, I think so. It makes the labor market tighter. And we're going to get this
Right.
number later today. Of course, it's focused on the employment data. But later today, we're going to get this consumer credit number. And this is what I think consumers are doing. They're borrowing from the past to meet consumption. How do you borrow from the past? You go into your savings, you take equity out of your house as you refinance. And they're borrowing from the future. In the last 2 months of data, we've
Credit
had record
cards.
level of credit card use.
Have we
And
seen
this
this movie before, my friend?
Well, I think so, but the labor market, as today's numbers show, I mean, these kind of numbers in any other time would be considered very strong numbers. And so I do think people are coming back to the labor market. We see this in the non-farm payroll number, but I think that, I don't know about you, but I see my cost of living is jumping. And in
Yeah.
order to make up for that, I think it's also drawing people into the labor market. And how are we making ends meet? Our bosses are not giving us the kind of raises to match inflation. So what are we doing? We're borrowing to keep that consumption high. And I think that's sort of the late cycle indicator.
Yeah. Kind of a hangover. Look, I can understand after being locked up for 2 years that no one's going to be as price sensitive to go out and live life, not just exist in their abode. But I think there could be a pretty heavy hangover this fall when people realize prices aren't dropping and the money they've spent and the value of their assets have dropped. And could we have kind of like a self-fulfilling prophecy? Everyone's talking recession. People are starting, the job cuts are planning it, where people just get the mindset that we're going to have one, and they pull in their horns before really they see the, uh, their eyes, the light of the eyes of the recession.
Yeah, I'm afraid that while it's possible, I don't think it's likely. In fact, next week we're going to get retail sales for June, and the retail sales after some weakness are likely to jump back. And so
Okay.
I think so. I fully agree that the economy is slowing. We're headed for a recession. We're not there. We're not there yet. And I think the danger is we lean too far over our skis, anticipating one. And the first like hurdles in front of us. I think the big thing is still better news here. Federal Reserve is going to raise rates 75 basis points, and other countries are having their problems. I think about Europe. I mean, Europe has a new energy shock. They're beginning to ration energy in parts of Germany. You've got even though U.S. interest rates have come off a bit, European rates have fallen further. So the U.S. 2-year premium over Germany is the widest it's been for a couple of years. And then on top of that, Europe is trying to put together this package, this new tool to prevent, say, Italian bond yields from rising too fast against German bunds. And the market's sort of having second thoughts about that, which is seen as another weakness of the euro or weakness of the European monetary union.
Okay, Mark, I remember we talk every 3-4 months here on Face together, and it was a couple interviews ago, and you were saying way back then that I'm concerned about the economy beginning to weaken and the Fed tightening into it, so that you still have to have those concerns. And you're saying the Fed's going to go ahead, same pace, 75 basis points at the end of the month. Is that still a concern and more of a concern as time goes on?
Oh, yes, I think that I think that in some ways I'm sort of trying to straddle this middle ground between the people who say the U.S. economy is already in a recession
Right.
and those people who are sort of further who think a recession, perhaps like some Fed officials, can be avoided. And I'm sort of in between that camp, thinking that a recession is coming in. And it's not just monetary policy. I know that's what in the markets, that's what we mostly talk about. But take a look at fiscal policy. The U.S. budget deficit this year
Yeah.
has likely to be halved, 500 basis points. That's from a bit more than 10% to a bit more than 5% budget deficit. Still a large deficit, but when we sort of, me as an economist, as a strategist, when I hear a big fall in the deficit, I think that means a big loss in income. Because what's the government spending money on? The government's money spent
Yeah.
is someone else's income. And so we're going to lose income. So we got fiscal tightening, monetary tightening. We've got this energy shock still. As I mentioned before, oil prices typically double before the U.S. heads into recession.
That was yeah.
And we've more than doubled now. And I'm watching weekly initial jobless claims now. I'm watching the 4-week moving average, and it's almost back to where it was in 2019. So I'm concerned. I'm watching the continuing claims too, but I think that we are slowing down quicker than the Federal Reserve is. And that tells me really is that even though the market's got 3.5% Fed funds for year end priced in, I think that could be very well proved to be the peak this year. So all this talk about front loading, I think, is a misnomer. They were caught sort of with their hand in the cookie jar behind the curve. So they're playing catch up. And because of these headwinds to the economy, I think that we're going to see that market slowdown, accelerating, where the Fed has to hold off hiking next year.
Okay, so we should end this cycle by the end of the year. Maybe it'll turn into a Volcker scenario where they stop, and then everyone goes back to risk, and the markets all take off, and inflation is back, and they have to do it again.
Yeah, I mean, I don't think we're out of this big cycle. I think that the next step in the cycle is going to be, as you say, a tightening of policy. Then we're going to get a loosening of policy. And I think that the next cycle also, the sentiment in the foreign exchange market shifts from growth differentials, interest rate differentials, back to the twin deficits, large budget deficit and a large current account deficit.
So when the markets finally shift to that, and make it count by people's votes with their dollars. People have been talking about it for eons. Okay, that should be the end of this, spectacular bull run in the dollar, don't you think? Do you think that we're getting close to any kind of inflection point with all the fundamentals that you've just talked about with me over the last, 20 minutes, Mark? And,
Yeah, I'd like to think so. I mean, but that honestly, Dale, I've been trying to pick a top here in the dollar several times. We try to pick a top, and then
yeah,
we realize we're wrong. We limit our losses, and we
right,
look for another opportunity. And I'm afraid that we're not quite there yet for another opportunity. I too see the market stretched, but I don't see today's jobs number really
right,
changing the dynamics. And it's not just that slightly better things are happening here, but that there's also bad news streams still coming from Japan, which, their economic recovery looks like it's stalling after they contracted in Q1 as well. And then, of course, a host of European problems. So we need better news stream from there. Would really help to pick a top for the dollar.
okay. And I'd like to know what you're thinking for next week. The NFP, we didn't have a ton of volatility, but everyone's saying the CPI next week is the biggest number in 1,000 years in the market.
Yeah, I don't know. I think
Uh-huh.
that we already know what's going to happen in some ways, right? We already have a pretty good idea that the headline accelerated. And we also have a good idea that the core rate decelerated. So what? So the Federal Reserve is still going to go 75 basis points later this month, which is already priced in the market, 50 basis
Right.
points in September, already priced in the market. So I think that that's what's going to happen, right? Is that the news for the dollar, I think, is being priced into the market. And now with the momentum traders, like many of us are, trend followers, like many of us are still pushing our luck because the euro hasn't been able to sustain upticks. The dollar yen is still driven by the 10-year US rates, which continue to hover around 3%. So I think that we know more or less the scenario for next week. I think the surprise will be that still the resilience of the economy coming from retail sales and industrial production.
Okay, so let me ask you about, you brought up yields. The kind of swings we're having, when you and I were back in Chicago, and we saw some of those swings in interest rate pits. A lot of people are saying that it's a sign of instability. It's almost like how debt markets are in banana republics. You think they're exaggerating?
Yeah, I mean, I think what's remarkable to me is that the move, which is sort of the bond market equivalent to the VIX,
Okay.
is at very high levels, higher than
Yeah.
it was in 2020. But I think that this really is a testimony to really the strength of our financial system, because this kind of volatility has not really disrupted things. At the end of the
No.
day, yes, it's maybe a little bit harder for traders like ourselves to make money in this kind of volatile bond market.
Bids are wider. Bid offers are
Bid
wider,
offers
right?
are wider. You get bigger moves during the day. So
Yep.
people who are vol junkies, you really can get your fill there in the bond market, which is more volatile often than the equity markets has been. And yet, I think that the fact that we're not talking about financial instability right now. I know these claims about Banana Republic or whatever, but at the end of the day, I think that the auctions in the U.S., the bond market itself, the fact that there hasn't been a policy response, the fact that people are not like jumping up and down talking about the financial stability, I think is a
Okay.
testimony to the ability of the capital markets to absorb this kind of volatility without becoming unhinged.
What a patriotic thing to say a few days after the 4th, Mark. We still have the deepest markets, the highest integrity in the world in our markets, and that's where money is treated best when they want to park it. Any comment on this recent bond rally, bear market rally, or is it more significant before I let you go?
Yeah, I don't know. Here's what I think is that if one would assume that the Fed funds are going to peak, that its overnight money is going to peak at 3.25 to 3.5, then I ask myself, what is fair value for a 10-year yield? And I think that fair value is around 3%. And so
Okay.
that means there's probably value as we like move back to the highs in the yield. There's value up there, and I think they will see not only Americans but foreign investors buy it. But for us Americans, here's a trade, not so much a trade, but as an investment idea. Where can one get 9% right now? The I bonds, the U.S. government sells
My sister asked me about those. And
Good.
I said, yeah, I didn't even know about them, Mark. And I go, they look fine.
This is for everybody and their sister. Is
Yeah,
inflation-linked bonds sold directly by the Treasury. You get them
yeah,
online. So the caveat is you can only maximum of $10,000 per Social Security number per
yeah,
year, but you can
yeah.
get over 9% taking just the government as your counterparty. That's the risk you're taking on, the U.S. government getting 9% on these I bonds, inflation-linked securities made for retail investors.
Yeah, what a great product. What took you so long? You know?
Exactly, huh?
Yeah, so Mark, thank you. I know you got to run. It's a busy day for you. I appreciate you coming. I love talking to you. I feel like we're old friends. I think everyone that's watching or sees the video later, you can always keep up with Mark on Twitter at Mark Making Sense, and then go to his blog, and maybe there's something he could do for you at Bannockburn. And Mark, have a great summer, my training warrior brother.
Thanks,
Thank you
and good
again.
luck. Good luck to everybody.
Yeah, good luck, and we're not against luck, right? All for luck.
I
Good
keep
luck,
that.
America. How about
I
good
keep it.
luck, America, right now, Mark?
Good
Do we
luck,
need
America.
some?
I know that I have the same sign in my office as I think you do. Right? The harder I work, the luckier I get.
Yeah, and you know what? It works. All
At
right,
least something
buddy.
does, huh? Good luck, man.
Yeah. All right, Mark. Everyone, Marc Chandler. Hope you enjoyed it, and everyone have a great weekend. You could join the team in 25 minutes on the Morning Edge. And guys, do your work over the weekend. I'm very amazed at all the people that are passing assessments. I don't have the energy to do it, but some of you young guys out there, what a great way to go if you're underfunded, to find a way to do that and, have some real money to trade. If anything, what an experience it would be for you. So thank you everyone for your support. The way to say thank you is get involved with us. Have a great weekend. And I'll say goodbye for the whole dream team. And remember, most of all, we're here, we're free. I know, the great reset is happening, whatever it is, but uh, money comes and goes. Time is gone forever. Make it count. So have a great weekend, everybody. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.